In 2008, almost nobody believed the financial system could suddenly collapse under its own weight. Banks looked powerful, stock markets appeared stable, and consumers continued borrowing money as if the boom would never end. Television networks reassured investors that the economy remained fundamentally strong despite growing cracks beneath the surface. Then, within months, major financial institutions started failing, and global panic spread through the banking system. Lehman Brothers collapsed in September 2008 after holding billions of dollars in toxic mortgage-backed securities. Credit markets froze, businesses lost access to funding, and millions of workers suddenly faced unemployment. The Dow Jones Industrial Average lost more than 50% of its value between 2007 and early 2009. Retirement accounts evaporated, housing prices collapsed, and entire economies entered deep recession. What made the crisis terrifying was not only the scale of the destruction, but the speed at which confidence disappeared. A system built on debt and trust unraveled like a bridge collapsing under invisible pressure. Today, another warning sign is quietly appearing inside the global economy once again. Most people still do not notice it because surface-level economic activity continues to look relatively normal. Consumers are still shopping, restaurants remain busy, and markets continue moving higher on certain trading days. Yet, underneath the headlines, pressure is building inside the financial system, just as it did before previous crises. Smart investors have already started changing their behavior in response to these signals. Large institutions are increasing cash reserves, buying defensive assets, and preparing for slower economic growth. Major corporations are warning shareholders about weakening consumer demand and rising financial strain. Central banks are also becoming increasingly cautious as debt levels continue climbing across developed economies. The frightening reality is that economic collapses rarely begin with sudden chaos. They usually begin quietly, while most people believe everything is still under control. Every major financial crisis in modern history followed a similar pattern before the breakdown arrived. Debt expanded rapidly, borrowing costs changed, and economic activity started slowing beneath the surface. The most reliable warning sign behind many of these collapses has been the combination of rising debt pressure and slowing economic growth. This pattern appeared before the Great Depression, before the 2000 dot-com crash, and before the 2008 financial crisis. Economists often compare the economy to a giant machine powered by credit and confidence. When debt becomes too heavy, the machine keeps moving for a while before parts suddenly begin breaking apart. One of the clearest indicators of this pressure has historically been the yield curve inversion. This occurs when short-term government bond yields rise above long-term bond yields, signaling expectations of future economic weakness. Under normal conditions, long-term bonds pay higher interest because investors face greater uncertainty over time. When the opposite happens, it suggests investors expect slower growth and lower interest rates ahead. The United States yield curve inverted before every recession since the 1970s with remarkable consistency. This warning appeared before the recessions of 1980, 1990, 2001, and 2008. Before the 2008 crisis, the yield curve inverted in 2006 while housing markets still looked strong. Millions of Americans continued taking mortgages even as deeper financial stress quietly expanded through the banking system. Banks had aggressively increased lending during the early 2000s because interest rates remained historically low after the 2001 recession. Cheap money encouraged consumers, corporations, and governments to accumulate massive amounts of debt. Between 2000 and 2007, total United States household debt nearly doubled from around $7 trillion to more than $13 trillion. Housing prices surged rapidly as easy credit pushed buyers into increasingly expensive properties. Mortgage lenders approved risky loans for borrowers with weak credit histories because rising home prices created a false sense of safety. Financial institutions packaged these mortgages into securities and sold them throughout the global banking system. The danger was hidden because the economy continued expanding during the debt boom. Employment remained stable, consumer spending stayed high, and financial markets projected confidence. Yet behind the optimism, the foundation of the economy was becoming dangerously fragile. Rising debt acted like pressure building inside a sealed container waiting for a fracture point. When interest rates started rising and mortgage payments became harder to manage, defaults began increasing across the housing market. That pressure eventually spread into banks, investment firms, and international credit markets. By late 2008, the United States government approved a $700 billion bank rescue package known as TARP. Policymakers feared the entire global financial system could collapse without emergency intervention. The crisis demonstrated how quickly debt-fueled growth can reverse into economic destruction. Years of artificial expansion suddenly transformed into layoffs, bankruptcies, and collapsing consumer confidence. History shows this pattern did not begin in 2008 alone. Similar debt-driven cycles appeared repeatedly throughout modern economic history. In 1929, the United States experienced one of the most devastating financial collapses ever recorded. Stock prices crashed after years of speculative borrowing and excessive optimism during the Roaring Twenties. Many investors purchased stocks using borrowed money because they believed prices would continue rising indefinitely. Margin debt allowed people to control large investments with only small amounts of personal capital. When prices started falling in October 1929, panic selling spread rapidly across financial markets. Investors rushed to repay loans while banks faced mounting losses and collapsing confidence. The Great Depression that followed caused United States unemployment to reach nearly 25% by 1933. Thousands of banks failed as businesses shut down and families lost savings accumulated over decades. Governments at the time struggled to stabilize collapsing economies because monetary systems were tied to the gold standard. Central banks had limited flexibility to expand money supplies during periods of severe financial stress. The crisis forced major changes to banking laws and financial regulation across the United States. In 1933, the Glass-Steagall Act separated commercial banking from investment banking activities. Policymakers hoped these reforms would reduce systemic risk and prevent excessive financial speculation. Yet over time, many restrictions were weakened as global finance expanded and debt levels increased again. The cycle repeated in Japan during the late 1980s, after years of rapid credit expansion and asset inflation. Real estate prices and stock markets surged as banks aggressively financed speculative investments. By 1990, Japan's Nikkei stock index collapsed after reaching historic highs near 39,000 points. Property values also fell sharply, leaving banks trapped under enormous amounts of bad debt. Japan entered a prolonged period of stagnation commonly known as the lost decades. Economic growth weakened, wages stagnated, and deflation became a persistent challenge for policymakers. The Japanese crisis revealed how difficult it becomes to restart growth once debt burdens overwhelm economic activity. Even extremely low interest rates failed to fully revive borrowing and consumer demand. Another major warning appeared before the 2000 dot-com crash in the United States. Technology stocks soared during the late 1990s as investors poured money into internet companies with little or no profit. Speculative excitement pushed the Nasdaq Composite above 5,000 points by March 2000. Many companies achieved enormous valuations, despite lacking sustainable business models or stable revenue. When confidence finally weakened, the technology bubble burst with devastating speed. The Nasdaq eventually lost nearly 78% of its value between 2000 and 2002. The Federal Reserve lowered interest rates aggressively after the dot-com collapse to support economic recovery. Now, those lower rates later contributed to the housing and credit bubble that expanded during the mid-2000s. This pattern reveals an important reality about modern financial systems. Crises often emerge from attempts to solve previous crises through even larger amounts of debt and liquidity. Governments around the world dramatically increased borrowing after the 2008 financial collapse. Central banks also injected trillions of dollars into markets through quantitative easing programs. Quantitative easing allowed central banks to purchase government bonds and financial assets using newly created money. The goal was to reduce borrowing costs and stimulate economic activity after the recession. These policies helped stabilize financial markets in the short term. However, they also encouraged even greater dependence on cheap credit throughout the global economy. Global debt reached record levels during the following decade as governments, corporations, and consumers borrowed heavily. According to the Institute of International Finance, worldwide debt surpassed $300 trillion in the early 2020s. The COVID-19 pandemic accelerated this trend as governments introduced massive emergency spending programs. Central banks simultaneously reduced interest rates to near zero while expanding money creation. During 2020 alone, the United States government approved trillions of dollars in stimulus measures to support households and businesses. Similar policies appeared across Europe, Japan, and other major economies. Initially, these interventions prevented a deeper economic collapse during the pandemic lockdowns. Yet the long-term side effects soon became increasingly visible through inflation and rising living costs. Inflation in the United States surged above 9% in June 2022, reaching its highest level in 4 decades. Energy prices, housing costs, and food expenses increased sharply across many countries. Central banks responded by rapidly increasing interest rates to slow inflationary pressure. The Federal Reserve implemented its fastest series of rate hikes since the early 1980s. Higher interest rates immediately increased borrowing costs across the economy. Mortgage payments rose, corporate financing became more expensive, and consumers faced growing financial strain. This created a dangerous environment because global debt levels were already historically high before rates increased. Economies built on cheap money suddenly faced the stress of more expensive credit. Housing markets began slowing as affordability deteriorated for millions of potential buyers. In many cities, average home prices had risen far faster than wage growth during the previous decade. Credit card debt in the United States also climbed above $1 trillion as consumers struggled with rising costs. Many households increasingly relied on borrowing simply to maintain normal spending levels. This trend matters because consumer spending drives a large portion of modern economic activity. When households weaken financially, entire economies become vulnerable to slower growth and instability. At the same time, businesses started reporting declining demand and weaker earnings forecasts. Large corporations reduced hiring plans while some industries announced significant layoffs. Technology firms that expanded aggressively during the pandemic began cutting thousands of jobs by 2023. Companies cited slowing revenue growth and uncertainty surrounding future economic conditions. Banks also became more cautious about lending as financial risks increased. Tighter credit standards historically appear before periods of economic slowdown and recession. Meanwhile, government debt continued rising at extraordinary speed across developed economies. The United States national debt surpassed $34 trillion during the mid-2020s. Servicing this debt became increasingly expensive as interest rates moved higher. Governments faced growing pressure between controlling inflation and maintaining economic growth. This situation resembles a financial balancing act performed high above the ground. Policymakers must control debt pressure without triggering a severe economic contraction. The yield curve inverted again during this period, reviving fears of a future recession. Historically, this signal has reflected investor expectations that economic weakness will eventually force central banks to lower rates. Many analysts dismissed the warning because employment figures initially remained relatively strong. Yet previous crises also developed gradually, while labor markets still appeared stable. Economic downturns rarely announce themselves with immediate panic at the beginning. They emerge slowly as pressure accumulates through debt, declining confidence, and tightening financial conditions. The European sovereign debt crisis after 2010 provides another important example of this process. Countries such as Greece accumulated enormous debt burdens that became unsustainable after the global recession. Greek government debt exceeded 170% of gross domestic product during the crisis period. Investors feared default, bond yields surged, and the country required international bailout assistance. Severe austerity measures followed as governments attempted to reduce deficits and stabilize finances. Public wages fell, unemployment increased dramatically, and economic output contracted sharply. The crisis exposed structural weaknesses inside the European monetary system. Countries sharing a common currency faced limited flexibility when responding to national debt emergencies. Argentina experienced similar debt-related instability multiple times during its modern economic history. In 2001, the country defaulted on approximately $100 billion of sovereign debt. Currency pressure intensified as confidence in the Argentine peso deteriorated rapidly. Inflation surged while banking restrictions triggered public anger and widespread protests. These examples demonstrate how debt crises often evolve from years of unsustainable financial imbalances. Problems remain manageable temporarily until confidence suddenly begins collapsing. Confidence is one of the most important yet fragile components of any economic system. Modern banking functions. Because people trust institutions to protect deposits and maintain stability. When confidence weakens, financial systems can unravel with astonishing speed. Depositors withdraw money, investors sell assets, and credit availability quickly deteriorates. This is why central banks monitor financial conditions so carefully during periods of economic stress. Small disruptions can spread rapidly through globally interconnected markets and institutions. Today's financial system is more interconnected than at any previous point in history. Banks, corporations, governments, and investment funds remain deeply linked through debt and global capital flows. That interconnectedness creates efficiency during stable periods, but increases vulnerability during crises. A shock in one sector or country can quickly spread across international markets. The collapse of Silicon Valley Bank in 2023 demonstrated how rapidly confidence problems can emerge. Rising interest rates weakened bond portfolios, while depositors rushed to withdraw funds simultaneously. Although regulators intervened quickly, the event reminded investors of hidden risks inside modern banking systems. Problems created during long periods of low interest rates can suddenly surface when financial conditions tighten. Commercial real estate also became an area of growing concern after the pandemic transformed workplace behavior. Office vacancy rates increased sharply in many cities as remote work reduced demand for corporate space. Property owners faced refinancing challenges because higher interest rates increased borrowing costs substantially. Banks exposed to commercial real estate loans became vulnerable to potential losses. At the same time, geopolitical tensions added further uncertainty to the global economy. Trade disruptions, energy instability, and regional conflicts increased pressure on supply chains and inflation. Economic systems function most effectively during periods of stability and predictable trade relationships. Geopolitical fragmentation can increase costs while reducing overall efficiency and growth. Another major concern involves the long-term strength of reserve currencies and sovereign debt markets. The United States dollar remains the dominant global reserve currency, but rising debt levels continue raising questions about sustainability. Historically, reserve currency systems changed when debt burdens and geopolitical power shifted significantly. The British pound gradually lost dominance during the 20th century as the United States emerged economically stronger. Reserve currency transitions usually occur slowly over many decades rather than suddenly overnight. However, excessive borrowing and declining fiscal discipline can weaken long-term confidence. Central banks around the world have also increased gold purchases in recent years. Many governments view gold as protection against currency instability and geopolitical uncertainty. This behavior reflects broader concerns about the future direction of the global financial system. Investors and institutions often seek safer assets when economic risks appear to increase. Yet financial crises affect ordinary people far more than institutional investors. Workers lose jobs, savings lose purchasing power, and small businesses struggle to survive during downturns. Inflation acts like a hidden tax that slowly reduces the value of money over time. Families may continue earning income while finding daily necessities increasingly difficult to afford. Economic stress also creates psychological pressure across entire societies. Uncertainty about employment, housing, and financial security can damage consumer confidence for years. History repeatedly shows that major crises begin quietly before becoming impossible to ignore. Warning signs appear early, but optimism and short-term stability often prevent widespread concern. The challenge is that debt-fueled growth can appear healthy during expansion phases. Borrowing increases spending temporarily while hiding deeper structural weaknesses underneath. Eventually, however, debt requires repayment or refinancing under changing financial conditions. When rates rise or growth slows, the pressure becomes increasingly difficult to manage. This does not guarantee an immediate collapse or another global financial crisis tomorrow. Economies are complex systems influenced by technology, demographics, policy decisions, and geopolitical events. However, the warning signs appearing today closely resemble patterns observed before previous downturns. Rising debt, slowing growth, tighter credit, and inverted yield curves have historically signaled increasing instability. Even central bankers and major financial institutions openly discuss these risks more frequently now. Concerns about debt sustainability and long-term growth have become central topics in global economic discussions. The modern economy increasingly depends on constant intervention from central banks and governments to maintain stability. Markets often react sharply whenever investors believe support measures may weaken. This creates a dangerous cycle where financial systems become dependent on low rates and expanding liquidity. Over time, that dependency reduces flexibility during future periods of inflation or crisis.